This is the beginning of part 3 of our module on callable bonds and swaptions, which describes and analyzes the mechanics, pricing, and certain applications of callable bonds and swaptions from a trader and end-user perspective. We remind you that this part 3 contains chapters 5 and 6 of the module, with chapter 5 illustrating a number of applications of swaptions and callable bonds, and chapter 6 containing the final quiz. This chapter 5 illustrates a number of applications of swaptions and callable bonds, including how swaptions are often combined with callable bonds to provide cost-efficient financing for issuers. But we begin first by introducing extendable interest rate swaps, which give the owner the right at a specific time or times in the future to extend the swap tenor for a predetermined period at the same fixed rate as the current one. And we invite you to think about how you might use the models we presented in earlier chapters to price such an instrument. Return to the case of the flat LIBOR curve that stood at 6% for all maturities, and consider a borrower with a 7-year loan paying LIBOR plus 75 basis points, say, who believes it is probable that he will prepay this loan in 2 years from the proceeds of an asset disposal, failing which the loan will probably remain outstanding for all 7 years. Should this borrower hedge his debt with a 2-year IRS, a 7-year IRS, or with something else? Either the 2-year or the 7-year IRS would bring his all-in cost, of course, to 6.75% fixed for as long as the swap remained in place. But might we be able to construct a 2-year IRS extendable at the borrower's option into a 7-year IRS in case he does not end up prepaying the loan? And if so, what would be the fixed rate under such an instrument? Regrettably, the answer is not so simple as saying that since the curve is flat, this third alternative would also have a 6% fixed leg. We need first to deconstruct this instrument into a vanilla IRS plus or minus a swaption, and suggest we do so here by viewing this extendable swap as a 2-year off-market pay-fixed swap whose fixed leg is stated for now to pay K% per annum, to which we also attach a 2x5 payer swaption in favor of the borrower. So the borrower has fixed his cost for years 1 and 2 at K% and can extend this protection again at K% at the end of the 2 years for another 5 years if he has not prepaid the loan, and if the K% fixed rate available to him if he chooses to extend the swap is still competitive at current rates. Assuming no profit to the dealer, we need to structure a zero NPV transaction, knowing that the swaption, like any option, has a positive NPV in favor of its holder, i.e. in favor of the borrower, So to bring the aggregate NPV to 0, we need to solve for the value of K, the fixed leg of the 2-year swap, and also of the 5-year swap underlying the swaption, that will bring to 0 the sum of the PVs of these two instruments. In effect, the borrower will enter into an off-market swap for years 1 and 2, whose negative PV, from his perspective, offsets the positive PV of the 2x5 payer swaption that the bank will grant him in exchange. Worksheet Extendable contains pricing for both the 2-year swap and the 2x5 payer swaption. You will need to review our earlier modules on interest rate forwards and swaps if you do not remember how to calculate the PV of an IRS. But like any fixed income instrument, its PV is simply the PV of one leg minus that of the other leg, with all future floating rate payments assumed to reset at the implied LIBOR forward rate for that reset date, and the current swap or zero coupon curve being used to generate the PVs, ideally via individual discount factors for each maturity. So in this worksheet, you see the data and cell entries exactly as before, plus in cell L11 here, the premium for the 2x5 payer swaption struck at K%. Then in cell L14, the calculation of the spot starting 2-year swap, which we will need to calculate the value of the off-market rate 2-year swap the borrower enters into on day 1. Then in cell L16, down here, the PV of this off-market rate swap. And finally, in cell L18, the sum of the swaption premium plus the PV of the off-market rate swap, which combined together become the extendable, and whose NPV will be set to 0 in just a moment to solve for the correct value of K%. Note that to obtain a negative PV on the swap in this cell L16, we have to set K% to be above the market swap rate of 6%, since we are modeling the payer's perspective here. Now we goal seek cell L18 to value 0, by changing cell L5, where K% appears, revealing a solution of 7.2256% for K. So the borrower pays an additional 122 basis points on the swap for the first 2 years in return for obtaining the right to extend this swap for another 5 years in his sole discretion at the same rate of 7.2256%, irrespective of the 5-year swap rate at that time. Note the European style nature of the option in this case, giving the borrower only one extension option on one specific future date. And note also that if the borrower no longer needs the swap in 2 years' time, but the option nonetheless is in the money, i.e., if the actual spot rate for a 5-year IRS is above 7.2256%, the borrower would not simply walk away without exercising, but would ask the bank to cash settle the underlying swap immediately and receive the PV of the difference between the then 5-year swap rate and the 7.2256%. The second swaption application we illustrate in this chapter is their use in connection with callable bonds to generate cost savings for high-grade borrowers such as Fannie Mae and other U.S. agencies before the beginning of the credit crisis. We illustrate this application by stating the market conditions first. Assume Fannie Mae, rated AAA, is able to borrow for any maturity on a fixed rate basis at the swap rate flat or at LIBOR flat in the FRN market. Assume the swap curve is perfectly flat at 6%, the one we used before, and that vols in the swaption market are 30% for any combination of maturity and strike. Assume finally that the retail bond market investors are unsophisticated with regard to option valuation and tend to purchase callable bonds at only a small coupon premium over non-callable bonds, say 50 basis points, irrespective of other specifics. So, in a nutshell, Fannie Mae could issue either 7-year straight debt at 6% or 7-year debt callable in 2 years at par if it pays a coupon of 6.5%. The CFO has expressed a very strong preference for 7-year fixed-rate funding, so is leaning away from the callable instrument, even though the 50 basis point annual premium on the coupon does appear unusually modest relative to the potential savings of refinancing at what could be a much lower 5-year rate. But consider what happens if Fannie Mae adopts the following structure. 1. Issue the 7-year callable at 6.5%, and then 2. Turn around and sell to the bank a 2x5 receiver swaption struck at 6.5%, earning an upfront premium shortly to be shown to equal 88 basis points per annum, which will subsidize the firm's funding cost initially, but may leave the firm presumably exposed to significant losses if rates move unfavorably. Worksheet swaption flat curve reveals that the 2x5 receiver, if struck at 6.5%, would earn Fannie Mae an upfront premium of 4.9957%. This is visibly substantially more than the present value of the extra 50 basis points Fannie Mae is paying on the callable, even if that instrument remains outstanding for the entire 7 years. Indeed, if we annuitize this upfront premium over 7 years semi-annually at a 6% annuitization rate, we would find it is equivalent to 88 basis points, as we had alerted you to expect. So well above the premium of 50 basis points under the callable bond. Is this difference entirely again pocketed risk-free by Fannie Mae? Let us examine the two possible scenarios and determine the all-in cost over 7 years for the issuer under each. Scenario 1. On the bond's second anniversary, the 5-year swap rate is above 6.5%. The bank will therefore let the swaption lapse. Fannie Mae, in turn, would see no reason to call the bond and refinance it at a higher rate, so it leaves it in place for the remaining 5 years. Our diagram shows clearly that this leaves Fannie Mae paying 5.62% fixed on an all-in basis. Scenario 2. On the bond's second anniversary, the 5-year swap rate is below 6.5%. The bank will therefore exercise the swaption and enter into a 5-year 6.5% swap with Fannie Mae, under which Fannie Mae receives LIBOR and pays fixed. But Fannie Mae can offset this by calling the bond and replacing it with a 5-year FRN paying LIBOR flat. Again, our diagram shows clearly that all this leaves Fannie Mae paying 5.62% fixed on an all-in basis. So in conclusion, Fannie Mae is assured to pay fixed, directly or synthetically, for the entire 7 years under either scenario. But it received on day one a premium whose annualized value was 88 basis points, bringing down the effective all-in cost for the 7 years to only 5.62%, and saving it 38 basis points net per annum. Is the example realistic, and to what exactly do we attribute the significant value generated for the issuer? In essence, the borrower has taken advantage of a serious mispricing of interest rate optionality in the retail bond market that purchases Fannie Mae paper. The call option Fannie Mae has bought under the 7-year Fannie Mae bond, being a right to replace outflows at 6.5% with outflows at LIBOR for the bond's last 5 years, is economically identical to being long a 2x5 receiver, which is priced in the interbank swaption market at 88 basis points per annum. The less sophisticated retail market, attracted to Fannie Mae principally on account of its AAA rating, and not particularly conversant with reinvestment risk and other esoterics, views the 50 basis points annually under the callable perhaps not quite like free money, but something certainly very close to it. Fannie Mae, in effect, is buying this option cheap in the retail market, then reselling it in the market, which appreciates its value fully and is prepared to pay the right price for it. The 38 basis point difference is Fannie Mae's to keep. Today, savings of this size are unrealistic in the US market, but they may still occur in the less liquid markets, and in any event, the illustration is an excellent example of arbitrage funding strategies at their best. Some of our listeners, we suspect, may feel a little uneasy to learn that the really big money in finance comes so often from exploiting the ignorance of the retail investor. The third and final application we discuss in this chapter is the inclusion of call features in numerous forms of structured notes to enhance further the headline coupon the arranger can show the investor. Structured investment products come in an infinite variety of guises and relate to numerous asset classes, from interest rates and FX to credit and commodities. Several of our modules are dedicated to them, given their importance to the derivatives and investment businesses, and many of these products are offered in either non-callable and callable alternatives. Consider, for example, an investor who expects dollar LIBOR to decline, so asks to be shown a variety of inverse floaters. You show her first a simple vanilla alternative paying 10% minus LIBOR when the curve lies at 5%, say. Then you show her a leveraged version paying 20% minus 3 times LIBOR. Then you improve this to 22% minus 3 times LIBOR, but place a cap on her coupon at 13%. Next, you make the instrument callable on its first anniversary only, which enables you to increase the coupon up to 23% minus 3 times LIBOR. Finally, you make the call feature Bermudan and increase the coupon to 24% minus 3 times LIBOR. The process, as you can see, is one in which different features are added gradually to the structure, each introducing its own risks, of course, but enabling you to offer the headline coupon, as it is called, in return for asking the investor to accept additional risks that may not trouble her particularly. The last 2 steps in the above process involved, as you saw, the inclusion of a call feature to enhance yield, initially a European one, and then the more expensive Bermudan version. We should mention that the numbers in this illustration were not confirmed via a pricing model and were used simply to make the teaching point. This completes Chapter 5.